There are many good consultants, advisors out there, but we are quite operationally embedded in the engagements we have. I think that sets us apart. You don't just lose money, you also lose time. Because you can always raise money, but you cannot raise time. When you see a turmoil coming up, how can you adapt? Can you actually shift your business model a little bit? Can you change your unit economics? Can you change your OPEX? Especially on the corporate institutional side, people are realizing the benefits of using stablecoin rails. There are many different applications. Your payroll might be in stablecoins. Your vendor payments might be in stablecoins. So we're going to see more fiat first or crypto first companies converging as these capabilities become closer with regulations. And I think that's the exciting part.
Today, we're diving into the intersection of fintech, payments, and Web3 with someone who has built and scaled products across the most complex and comprehensive markets in the world. Elbruz Yilmaz is an operator, investor, and advisor who has held senior leadership roles at Bitpanda, PaySafe, and now leads Outrun, which is a company, a strategic advisor and venture studio helping companies accelerate growth, navigate Web3, and bring regulated digital asset products to the market faster. We're going to talk about scaling in messy markets, the new era of fractional C-level leadership, how stablecoins are reshaping global payments, and what founders actually get wrong when trying to grow. Elbruz, it's great to have you here.
Nasib, good to see you again. Thank you for having me.
Let's start with your background and personal journey. You've worked across Web3, payments, and fintech, as mentioned. What core insight did each of these chapters give you about building and scaling in messy markets?
Yeah, I think each journey was quite different, but also at the same time similar. I think one highlight is that building in messy markets is challenging and difficult, but also enables you to take those products to every other market. Because in emerging markets, when we say messy, customers want a reliable working product today, not a fancy roadmap that will look shiny and nice in the next 12 months. So they are very short-term focused, and they are quite demanding. They don't care about UX and UI too much. They just want something that works and solves their pain point that day. Obviously, when you're building a product like this, you need to also build it within the confines of if it's a regulated market with the regulatory guidelines, which means that sometimes speed suffers. And if you can get a disciplined execution in place and combine that with speed to market, then actually it looks like a winning formula. When you work in a larger organization, for example, PaySafe and other payment companies, there's a lot of ambition, lots of energy and resources around it. However, there's also friction because you're already engaging a company and their network of clients who are built in a certain way. They are consuming products in a certain way. And when you try to bring a new product online, for example, stablecoin payments, there's sometimes friction with internal processes, friction with client processes, etc. So I think it becomes a different challenge in a larger organization, where in Bitpanda, what we found out that is one size does not fit all. Even though you might be in a passportable license within Europe, each country, each market is quite different how they consume products. And when you're in a large organization like PaySafe, I think you need to have a very sharp focus on deliverable results. Otherwise, you lose momentum and friction creeps up. So similar approaches, but I think you highlight different aspects of the business a little bit differently. Yeah.
And what problem were you seeing in the market that led you to create Outrun?
With Outrun, I think we are all operators and we enjoy building things. What we realized were people were coming to us as a team asking our advice on how to go to market better, faster, how to bring a product to market faster, how to engage with different product partnerships, etc. And we realized that it's not more of a market research report or analyst report, which with the AI, you can actually get most of these things done quite rapidly these days. They were looking for wisdom, and wisdom is not usually knowledge. They looked for partners who can actually tell them what's around the corner, how they can actually hire better when it comes to product talent or sales talent, how they can actually build a winning formula for product partnerships in different markets. So we sit between, I think, in most of our clients, they have a strong product suite, but they lack execution, and they're looking for a little bit more focused, sharper execution. And we come in as operators with results-driven approach, and we're not consultants in that sense. We're almost co-founders. And in some cases, we are fractional C-level partners, and we come in and engage to make sure that the whatever the initiatives we have, they go to market faster and the results are better. And I think we see this gap in the market right now that you have a lot of capital, especially VC-backed companies, and they are building, for example, when you look at stablecoin payment companies, they are building the next generation of e-money. And I think it requires a different, or let's say a diverse background. You need to understand regulated markets, you need to understand payments, you need to understand blockchain. So it's quite multidisciplinary. And we felt that our approach is quite unique, where we have operated on Web2, Web3 worlds, payments, fintech, and regulated environments. So we kind of bring that together as a distilled wisdom to our customers, where we are almost co-founders as their extension of their teams.
And you're operating internationally, right?
Yes, today most of our clients are in Europe. Some we have in LATAM, some we have in Turkey, my hometown, and then we have a few in MENA. Yeah.
Outrun positions itself as turning ambition into action. What kinds of founders or companies come to you? And what are they usually getting wrong before you step in?
I'll start with the second one. I think that's a little bit more visible to us. We see either executives or founders having too many initiatives. They are doing 20 different initiatives at 10% focus. And it's common sense. We want to have a much more laser sharp focus on fewer initiatives with 100% or 110%. So we help them stack rank these opportunities based on business cases and help them make better decisions sooner. Whether it is canceling a product initiative, whether it's canceling a market, whether it's canceling an investment into a licensed entity in a different jurisdiction. So it's mostly about refocusing existing resources into initiatives that will actually change the trajectory of the business that they're running. The other thing is most founders think and executives think scaling is just hiring more people. It is actually, if you scale chaos, you have more chaos. So what we try to do is work with them in developing a playbook that will work with them in different markets, in the different horizontal or vertical growth patterns. And we do this by, for example, taking a payment product and approaching a different vertical such as iGaming and saying, okay, this is how you win in this vertical. You need these key partnerships, your compliance needs to look this way, etc. So what they, I think, do wrong is scale the same way they have been scaling in different markets and different verticals, which is, again, not correct in most cases because they are quite different. For example, I joke about it. Europe can be divided into three. You have wine drinking Europe, you have beer drinking Europe, you have vodka drinking Europe. So I think they don't mix well. They consume things quite differently. Even though you might have the same license, your landing page design might be different, your community management on Telegram might be different, etc. So I think hyper-localization is key, and we try to support that. And then I think when you look at what they get right is most founders and executives are amazing when it comes to securing resources, whether it's fundraising or internal budgets. And they have actually a lot of ammunition when it comes to talent and resources at their disposal. But it feels that they just need a little bit more sharper focus on execution. So we try to convert, as you said at the beginning, that ambition into execution by, canceling some meetings and making sure that we can actually get some products to market faster, even if they're not perfect, just to get them to market faster.
May I wonder if you have had a situation which was actually quite the opposite, where they needed to hire, where they needed to focus on more than just a few things?
Maybe a few. I think what we see is that some companies fail because they are inadequately financed, which means that they don't have the necessary resources to execute the business plan that they ventured on. I think it's not about lack of talent or resources, but maybe it's lack of experience. We have done, let's say, as a VC before even Bitpanda and PaySafe days, I have seen many companies scale up in a many different way. And I think the most common things that they can employ is set up an advisory board, for example, that can actually help them with scaling, with introductions, or some operational functional areas where we talked about, you might not be able to afford a full-time CFO, but you can benefit from the wisdom of a fractional CFO who has done this and seen that before.
That's where you guys step in, right?
Yeah, we try to package our services, and I think at the C-suite, when it's about growth, you have a product position, you have a marketing position, you have a finance position, and I think if you don't package them, some people have struggled to connect that with their business lifecycle. So we have CMO as a service, where we go in ranging from 6 months to 12 months engagement, where we actually go in, build a team, set up a marketing strategy, and then execute towards that plan systematically with them as an embedded partner of the team. Obviously, once the company scales and grows, they can actually acquire their own C-level people. If they hit that threshold, they can hire a larger marketing team, for example, and we basically try to graduate ourselves from that company at the end of that journey. But in that transition period, especially if you have raised Series A financing and you want to show some growth KPIs, we try to come in and make sure that, even though they might not be able to afford a C-level person full-time yet in that function, well, they can still consume that fractionally. Yeah.
Mm-hmm. And was there a moment when you knew that traditional consulting model wasn't enough and that the different approach was needed?
Yeah, we have seen this firsthand. Sometimes companies actually resort to consultants to understand, if they can unlock some efficiencies, if they want to learn a new technological, trend. What we ended up seeing was that, most consultants provided guidance, but did not help with execution and internal digestion of that initiative. So we can do a deck that can look like $1 million, and somebody can read it and say, okay, this is amazing. Let's do what's written in this deck.
We need to cut the costs and increase the revenues.
Yeah, exactly. It's very common sense. But when you turn back and say, okay, now I know what I need to do, but how do I do it? I think it's quite different because you need to be really embedded. That's why our approach is mostly around, especially with our venture studio, we try to be a co-founder of the company that we are investing in, at least for a few years until they get to that trajectory. I think consulting is also changing with the age of AI. Everybody can talk to ChatGPT about many different things these days. But I think, as I said at the beginning, wisdom is not knowledge. By knowing stuff is something different than doing it actually, and making those mistakes makes you different. And I think there are many good consultants, advisors out there, but we are quite operationally embedded in the engagements we have. I think that sets us apart.
You work closely with VC and investment-backed startups. What's the biggest misconception founders have about scaling?
I think I've been a founder back in the day, many, many years ago, and I think you think success is one thing, but it actually isn't. So when you have a fundraising moment, you think the work is, going to get easier, it's going to get smoother. But on the contrary, if you're working 16 hours a day, now you have to work 18 hours a day because the ambition has doubled, quadrupled with that injection of capital. So I think, even though fundraising today is a competitive advantage, because especially when you talk about stablecoin space, you see a lot of companies getting funded by VCs. And if you're able to raise funds better, faster, bigger, it's a competitive advantage, definitely. But this is true for every VC cycle. AI is the same, others are the same. So I think one thing that I would say most VCs and founders misunderstand is scaling is not spending more money and hiring more people and just going bigger. Scaling is basically, you just need to make sure that your unit economics are properly done. You have a strategy that's super localized for the markets that you're entering. And then you have speed and execution discipline. But I would say the biggest misconception is that, scaling is thought that we need to grow 400 people, hire a lot of people. And every market is quite different. Even if you have a European playbook, it doesn't work in MENA. If you have a MENA playbook, it doesn't work in Africa. So you need to assume it's not going to work there, and you need to find out why and how it can fail before you start spending investment money on that. So I think those are the few things that come to my mind. Yeah.
You mentioned hiring a few times, but do you help them to hire through, how do you help them to hire, right? Are you present in the during those interviews, or are you hiring an external consultant that you cooperate with?
Yeah. So depending on our subject matter expertise, for example, if there's a blockchain security component, we don't provide that service. So we work with our friends that we know are battle tested and quite black belt. I think depending on subject matter, we might resort to work with other advisors that we know and trust. When it comes to hiring, we typically, depending on the scaling, trajectory of the business, if they are ready to grow and hire people, obviously they need to have a team constellation set up where we help them with what type of skills you need that in this team, who's going to do what, job descriptions, location sometimes, and then we obviously try to source within our network to help them. But usually our graduation happens when we have a team that replaces us as their fractional advisors. And then our success is actually to make sure that we are not needed after a certain time. So in that sense, we do help our clients. For example, we have a project in LATAM right now. We are building a crypto stablecoin product team from ground up. This also has an impact on compliance, finance, treasury, different functions. So we are actually building a crypto stablecoin organization for that client, which is adjacent to their core function. Yeah.
Mm-hmm. When you're doing discovery or processing discovery, what's the most common root issue you uncover? Something almost every company misunderstands about its own challenges.
I think when it comes to discovery, what we have seen is that most of the companies are working on solutions for symptoms. So they haven't done the product problem definition particularly. They haven't identified their core ideal customer or client base. And I think this creates a lot of wheel spinning when it comes to getting traction. So I think most of discovery is separating noise from signal and understanding what are the core issues, what are the core problems versus symptoms. And I think that's the main issue. Right now we have so much information out there. It is very easy to assume certain things based on data. And then the other day we were having a discussion about this, the founder says, what if there's no data? And I think we think that is one of the best excuses for not to make a decision. If you don't have evidence or data, you need to also find a way to experiment that and get that to market still to create that data set that can give you some signals. So I think when it comes to discovery, separating noise from signal is key. And we find out in most cases that we are only focusing on the symptoms versus the real problem, the pain points.
Where do founders burn the most time and money during early scale?
Again, I'm going to say unnecessary hirings. Because you think just because your trading volume goes up, if you're a crypto company, you need to 10x your compliance team, or you need to 10x your customer support team. Maybe you need to 20x it, I don't know, right? Depending on the volume. But all these peak times are quite indicative of cycles that can change quite rapidly. So you just need to have a better hiring plan. And I think, there's a method called top grading in the US, quite famous among VCs. This is based on hiring on a scorecard. So, and the rule set says that, if you're hiring a swimmer, who do you want to hire? Do you want to hire somebody who's a world record holder and an Olympian, or do you want to hire somebody who can swim? So I think you need to have some criteria based on each role to make sure that individuals can actually come with a scorecard to show that they have done that before, whether it's scaling a finance organization or compliance organization or product organization, so they can deliver. So they're not learning on the job where you need to run and spend that money. And most of these hirings, most people don't understand this, I think, until it's too late, is you don't just lose money, you also lose time. Because you can always raise money, but you cannot raise time. So if you hire the wrong C-level person and you're with that person for 9 to 12 months, you have burned that money, that's fine. I mean, at least you have quantitatively know how much money you've spent on it, hiring the person, salary, etc. but you have also lose 12 to 18 months, which is from an opportunity cost perspective, could be in millions. So I think founders, what we see is that they just do unnecessary hirings too early, too soon. And they underestimate the time that goes into those, either digesting those hires or getting rid of them. And then when you look at the common mistake is that they always underestimate the work. They think, oh, if I hire this many people, if I hire her, he or she will build a team. Have they done that before? They need to check and do their due diligence on that person. So I would say team and talent, whatever you call it, is the key area. Yeah.
You mentioned the market cycles, right? Market cycles, and the risk of a changing market cycle is not unique to just crypto markets, but also other markets too. We have geopolitical risks and so many other ones, right?
Sure.
Do you think that the company, instead of scaling, for example, in certain situations, it would be better for the company to prepare for a possible turmoil, because there is always a winter coming?
Yeah, I mean, this is very applicable in crypto. And I think if you use that analogy, like, I don't know, there were like maybe 8 elevators here in this building.
Okay.
So when you're building the building, there's an engineering that goes into peak time planning. You have certain amount of people, certain amount of square footage, and you want to move them up and down with elevators, right? So assume that you have only one elevator here. You'll have huge lines of people waiting to go up and down, and they'll be upset and frustrated. That's what happened in the first crypto cycle, where exchanges were down all the time. Kraken was down, Binance was down, this was several years ago, obviously, but you did not anticipate the demand to come in that big, that high, the volume. And on the other side, if you have here 200 elevators, you're not going to get utility out of it. So you're going to have certain peak times, but it's never going to reach that threshold of overage. So I think in business, in whatever business you're in, it's important to estimate and have a plan for scaling up and down depending on these cycles. And we have seen this in crypto. Many companies had to have a lot of layoffs when your single revenue stream, if it's only trading fees and the market goes on a winter type of situation where nobody's actually trading that much, or there are not enough new users coming in to buy the products that you're offering, then all the infrastructure investment that you have made has become idle because you don't get enough volume or number of customers. So you're actually, while you're reducing your revenues uncontrollably because it's not up to you, the market sentiment shifted, but your cost base remained high. So you couldn't actually lose weight as fast as possible. So I think companies need to also pay attention to this, and they need to estimate, have a plan B, plan C just in case. And I think one thing, when you look at COVID, it impacted travel industry, I think, the most. The ones that have acted faster, cut deeper in terms of cost and other things, survived, I think, better. Yes, most companies survived, and somehow with subsidies and support, etc. But many also went under during the period. And I think it's just a speed of execution makes a difference. So when you see a turmoil coming up, how can you adapt? Can you actually shift your business model a little bit? Can you change your unit economics? Can you change your OPEX? Those are, I think, key decision criteria for executives and founders to act quite rapidly.
Do you think processing stress tests help the product?
Yeah, I mean, nobody could have anticipated COVID, right? So I think, as I'm from Turkey, what we have seen is that Turkey has a lot of macroeconomic challenges, regional tensions, etc. So you have to adapt quickly in a high inflation, fragile local currency environment. So it's quite second nature for you to be adaptable and very short-term oriented. And I think this prepares, many people for a better survival test as an entrepreneur, as a business person. But I think this is applicable to the entire planet these days. It's quite volatile, and anything can affect, decisions globally. Yeah.
Why do you think fractional C-level roles, such as CMO and CFO, are becoming the preferred model for fast growth companies?
Yeah. There are, I think, a couple of reasons. Number one, most of these companies at their scale-up path, at certain times, they might not be able to afford the full cost of a C-suite. So they might not have a CFO type of person. They might not have a CMO type of person. They might not have a full board to give them guidance and direction. I think fractional C-level engagements are beneficial because A, they are less costly, number one. Secondly, when it comes to team dynamics and potential team politics, if there are any politics in that team, it doesn't become a execution hazard where you bring a new individual in full time. There might be a fit, there might not be a fit, you never know. So hiring becomes less risky. So if you can get somebody who has done the job before, knows what to do, and just helps you get to the next level better, I think those are very logical wins. So I think cost and team chemistry and team fit. And then thirdly, as we just discussed, when you look at these individuals, they work with multiple companies over the years of their engagement. So they bring in a distilled wisdom from these experiences. They are learning different topics, problems, mistakes at different areas. So you're actually tapping into that advice, library, basically. So it's not just you get a person who does, review accounting and financial reporting, for example, in a CFO. You have somebody a little bit more future strategic, path as well. Mm-hmm. Yeah.
When a startup thinks they need better marketing, what do they actually need 80% of the time?
This is, we just had a discussion the other day about this. 80% of the time is not marketing execution and it's not budget. 80% of the time is about narrative and positioning and strategy. So I think it is quite easy to deploy marketing capital today, online, offline. Many creative folks can actually execute a marketing plan. But I think most of the time what's wrongly, gotten is the narrative, the positioning, the messaging, strategy around it. Rest of it is, I think, once you have that lined up, it's quite smooth to execute. Yeah.
What separates strong strategic finance for founders from traditional CFO work?
I don't want to say traditional CFO work because CFO has become a key element of any organization that they're in, because it's not just finance anymore. For example, if you look at stablecoins, you have treasury, remittances, other things. So it's not just financial reporting, but I think a good CFO should have a forward-looking view as well of the business, not just reporting and analysis, but also saying, okay, this has happened, but this is how we can actually tackle larger obstacles, raise funding, etc. So I think the role of CFO has shifted from, just providing financial guidance to strategic guidance, using finance as a pillar. So I think that's the main difference these days that we see. In my opinion, a good CFO should be able to raise funds, should be able to do M&A, should be able to do due diligence on new investments, should help you with vendor selection, obviously do all the basic finance work as well, accounting, reporting, analysis, etc., manage cash flow, obviously. But I think CFOs have become, because of the tools we have, where you have integrated accounting, you have AI, etc., they are in a much more of a vantage point right now to detect patterns and provide insight for future decisions.
Since we mentioned stablecoins, you've been deep in the payments for years. How are stablecoins changing the economics of cross-border payments today?
Yeah, this is the hot topic these days since the summer. I think stablecoins have been around for a while, and they just have been not just have been discovered, but I think when you present the benefits of a stablecoin, for example, to a treasury manager, that they can actually send funds, almost like sending an email across the globe, then it clicks. And I think we had that aha moment since the summer where, especially on the corporate institutional side, people are realizing the benefits of using stablecoin rails. There are many different applications. Your payroll might be in stablecoins. Your vendor payments might be in stablecoins. Remittances, cross-border payments, etc. This is all becoming available and more visible. But I think we're just at the beginning, because stablecoins are programmable, next generation of e-money, and it's the most, I think, killer app of blockchain so far, where you're able to find some utility. And we have been there. Layer ones, most of them have zero or no utility. You look at, I don't know, NFT collections, etc., you haven't seen any benefit from it. So I think now we are in a different phase of blockchain utility where stablecoins are the killer app, and they are becoming much more embedded in financial operations of companies, whether you're payments, whether you're a bank, whether you're a global vendor, management company. And I think it's just the beginning. We're going to see more applications of it in institutional retail side. So super excited about it.
When you train companies on crypto payments, what's the biggest aha moment business leaders have?
I think we have done multiple workshops with different businesses. I would say Treasury is one of the key areas where they see how they can move money so easily across the planet. Consolidation becomes easier, costs go down, speed goes up. So that's kind of an aha moment for them that they're like, wow, this can really happen. And then I think you build different business cases, and each business case has a different ROI potential on them. So some of them are reducing costs, and some of them are unlocking new revenue for them. So we have been discussing, many companies are coming and indicating that, hey, we want to launch our stablecoin, and our approach is, wait, why? Like, why do you need a stablecoin issuance business? They just don't understand how the stablecoin companies make money. But to participate in the stablecoin economy, you don't really need to issue your own stablecoin. You just need to have a good treasury desk. Maybe Treasury is just an algorithm that runs for you, utilizing our stablecoin rails. And I think you just need to have good partners. You don't need to build everything ground up unless you have the investment need for it or the margin need for it. Many of the stablecoin ecosystem functionality is available off the shelf. There are many good companies out there providing all these pillars, the building blocks, custody, issuance, etc., compliance, blockchain analytics, etc. So I think it is quite. Once you have the decision internally, it's quite easy to get to an investment point on stablecoins. But I think the trick is, how do you calculate ROI and business case applicability for stablecoin businesses? So if you're a PSP, a payments company, what stablecoin applications you want to attack first, versus there are 27 different things you can do with stablecoins. So I think the other important thing is that they think that they have to do all this technological lift, product lift. And when you tell them, you just need to plug this one in here and this one talks to that one, and then it's quite actually easy from a lift point of view. And operationally, it's not a burden. You don't need to hire 300 people for your compliance team. You don't need to hire blockchain engineers. Then I think it becomes easier to digest. So initially, when you go to talk to somebody who hasn't done anything on stablecoins, their initial reaction is that this is going to be very complex, very difficult, but it's a learning curve. So once they pass that and you show them the potential benefits and do a few pilots, then it becomes easier for them to understand.
How should companies think about treasury efficiency in a world where programmable money becomes normal?
Yeah. So I think they need to treat treasury as a system, not as a department. They need to look at, liquidity, compliance, all of these things from a different perspective. And then it becomes easier for them to execute that function. Today, I think treasury has seen hedging against certain volatility or moving funds or consolidation or upside on the yields, etc. But it's not seen as a system. It's seen as a department. So I think when you look at PSPs or banks, how many people they employ, how many bank accounts they have to move money from, how many FX pairs they have to maintain, it's just too much. And I think once you have this approach of, okay, let's have an algorithm, a system that manages our treasury based on stablecoin rails, then it becomes clear.
You build crypto products inside global institutions. Where are enterprises actually seeing ROI from Web3 today?
I think a few places. So when you look at Web3, and I have to talk about stablecoins within the Web3 universe as well, obviously. Number one is stablecoin neobanks. Let's call it that way. So these guys are actually enabling you as a retailer, retail user, or as a merchant to utilize your stablecoin balance, whether it's spending, payments, or yield. So I think these are quite good applications. They enable you to have more, let's say, functionality with your stablecoin if you're a customer or a merchant. So I enjoy following up this vertical quite a bit. Then when you look at liquidity, obviously financing fiat liquidity with stablecoin liquidity is something that we are seeing. You can call it DeFi mullet, where front is fiat, the back is DeFi, or vice versa. I think when it comes to FX transactions, we are seeing some efficiencies there. Payroll is something that's exciting to me because I think when you are a global organization and you have, 200,000 employees on your payroll, different currencies, different localizations, stablecoins actually help mitigate some of the inefficiencies there. And obviously we talked about Treasury multiple times today. So yeah, those are some of the key applications where we see. Now, particularly when you look at Web3 first companies who are born into the realm stablecoins, I see an increasing convergence. And also there's a little bit about information asymmetry. Payment companies are moving to stablecoins. They come from a fiat first approach and they're trying to integrate that. And then you have some Web3 or crypto or stablecoin payment companies who are gaining fiat capabilities as regulations become clear. So I see this natural convergence. There'll be some M&A acquisitions, in my opinion. We have seen this in recent months. Stripe acquired a company. BVNK was approached by multiple companies to be acquired. So I think these capabilities and the volume that comes with it is going to be unique for the next few years. So we're going to see more fiat first or crypto first companies converging as these capabilities become closer with regulations. And I think that's the exciting part. This is now finally becoming more of a global pattern than just a company who has an idea to do XYZ. Yeah?
What sectors are most ahead in adopting token-based business models?
Today, with the convergence of these fiat-based and let's say stablecoin crypto-based worlds, I would say payments, because my thesis is that blockchain is built for payments. We're going to see a lot of traction on the payments, spending, and B2B payments. That's the area, in my opinion, at least in the next foreseeable future. And when you look at, the other patterns around blockchain technology, tokenization of assets is going to be a huge momentum in the next few years, I think. We haven't seen the tip of the iceberg yet.
Why is that?
I think it's just a natural cadence of the industry. When you have anything new technologically, there's a hype period, and after that, utility shows up. Mm-hmm. I think we just finished, or we are about to finish the hype period.
And we just began with stablecoins.
Stablecoins is the first utility application, and then I think RWA will follow suit after that, because we have now more institutional players interested in the technology space, in blockchain especially. And I think there's more institutional business models that can benefit from it, and it's becoming, as regulations also get a little bit more mature, it's becoming more approachable by them. Yeah.
If someone wanted to build real infrastructure in Web3 today, where should they not be looking anymore?
In what infrastructure?
Web3.
Web3 infrastructure. I would say don't do anything with NFTs. I think that's quite obvious. I would say instead of what not to do, I would say what to do is completely focus on stablecoin economy, and there's plenty of functional needs around it where you need better blockchain analytics around it, you need better compliance controls around it, you need better settlement times, etc. So anything that can enhance the stablecoin economy is something that we should look into. And then the intersection of stablecoins and payments, I have to emphasize, that's, I think, the biggest volume generating category right now.
And a bit later, tokenization.
Yes.
Right?
Yes.
And maybe digital identities, stuff like that.
Could be. Yeah. Not an expert on that particular one, but most likely, yes.
You support founders who move fast, think sharp, and aren't afraid to build in massive markets. That's a direct quotation. What does it take to stay alive in those environments?
I think you need to have a lot of grit. You need to be quite absorbent to anything that the world can throw at you.
Do you need to be obsessed?
Yeah, yes and no. I think yes, you need to wake up and sleep with the same idea and the vision in mind every day. You're obsessed about solving a problem, yes. But I think obsession can mean other things as well. for example, if you're obsessed with UI and UX, it might not even work, right? If you have the best elevator doors, but the elevator is not working, it doesn't make sense. So I think the obsession is solving a problem, yes. And building in messy markets, I think, gives you this survivability where you actually adapt to market needs, move fast, solve a problem, a real problem. It doesn't have to look nice. It doesn't have to be perfect. But customers want something reliable that works, and they will use it. So I think having that mindset is important.
Stay realistic and grounded, right?
Yeah.
What's the most underrated founder skill in 2025?
I would say being able to understand how credit cards used to work and how stablecoin payments will work. So I think you need to have a mind of both generations. And I think if you're a founder that gets to both sides, which in this case, somebody who can use a fax, an email, and cloud computing and AI, ChatGPT, then that's the mix, I think. And it doesn't have to be one individual, but in your founding team or in your executive team, you have that skill set and experience that could actually set you apart because you need to understand both sides.
There was an interesting, parallel between credit cards and stablecoins. I must ask a follow-up question. Why exactly this? Like in your view?
So if I wanted to buy something from you today, I can send you stablecoins. I don't particularly need a card for it. And that transaction is public, it's visible, there's evidence of it, etc. So I think you need to understand why we resorted to credit cards in the first place, security, not carrying cash, many different things. And I think the next generation of it is you have a lot of cards that are powered by stablecoin balances, but why do you even need a physical card anymore, right? It should be just a few sentences of lines of code that I sent to you and transaction is settled. So I think you need to understand the history of payments a little bit to understand where it's going to go. Because generationally, our elders use the payments differently. They will continue to use it differently until a certain time. We are getting older day by day, and then the younger generation will use payments completely differently. So you just need to understand how these products adhere to different generations growing up.
If we zoom out, what will payments look like in 2030?
Assuming that stablecoin adoption goes the same way, regulations are still progressive. I think you're looking at completely instant, borderless, and very seamless payments. You're looking at banks almost becoming like APIs, where you don't really need to actually even have certain custody functions. You never know. And then most of the things that we think are creating friction today are gone because crypto or stablecoins as a payment method is quite universal, quite global. And I think most users will not care about their payment methods. It will be quite native and seamless for them. And fast forward, I think we'll all benefit from the efficiencies that the stablecoins can unlock for banks, for payment companies, for us. So it's just an enhanced version of where we are today.
What is one belief about fintech or Web3 you hold that most people would disagree with?
I mean, I think many people might disagree with this, but I believe still blockchain is built for payments and nothing else. And that's the killer application, utility application, and whether it's stablecoins or different forms of blockchain. So I think
it was mentioned in the original white paper by Satoshi.
Yes. I think we have diverged from that speculative trading, layer ones, layer twos, NFTs, different things. But I think this was only, in my opinion, was designed for payments to solve a payment problem. It was never the store of value like gold or etc. So it just gotten away from us. And I think given the size of the industry today and how many tentacles it has, some people might disagree that it's the only application. But I think it's the killer application for blockchain.
Where's the best place for listeners to find you and follow Outrun's work?
I'm trying to be active on social media, so I would say LinkedIn and X. And our website has plenty of stuff there. We have our quarterly reports coming up. So I think those are some channels that they can stay engaged with us. Otherwise, just, drop me a note on Telegram as well.
I will include all the links in the description.
Yeah.
Elbruz, thank you for bringing clarity to one of the most complex and important intersections of fintech and Web3.
Thank you so much, Nasib. Pleasure. Thank you.
And to everyone listening or watching, like, subscribe, or follow both of us, and share this episode with someone curious.